Welcome back, everyone, to Simple Mind Space. Today, we're tackling a topic that's crucial for everyone, yet often neglected: building wealth. It's shocking, but a recent CNBC study found that a whopping 63% of Americans wouldn't be able to handle a $500 emergency expense. That's a staggering statistic, and it highlights a significant gap in financial literacy. Think about it. Our education system rarely emphasizes personal finance. We graduate without a clue about managing money, let alone growing it. Many parents themselves struggle with finances, making it even harder to pass on healthy habits. It's almost taboo to discuss money openly, which is a shame because building wealth is more achievable than many believe. Here's the reality. Achieving financial stability and accumulating wealth is simpler than you might think. You don't need a silver spoon or a Wall Street connection. With some basic knowledge and discipline, anyone can turn $100 into $1,000, $1,000 into $10,000, and so on, ultimately reaching $1 million or more. It's not a pipe dream. Studies show that 80% of millionaires didn't inherit their wealth. They built it themselves, often starting from humble beginnings. So what's the secret sauce? What's the blueprint that wealthy individuals follow? It's a combination of smart financial habits, strategic investing, and a long-term mindset. Today, I'm going to break down the steps you can take, starting right now, to achieve financial security and build lasting wealth. Step 1. Mastering your cash flow, the foundation of wealth. The first step, and arguably the most important, is understanding your cash flow. You need to know exactly where your money is going each month. Most people operate on a vague sense of their income and expenses, spending until their account runs low, then tightening the belt until the next paycheck arrives. This cycle leaves them vulnerable and prevents them from building a solid financial foundation. Wealthy individuals take a different approach. They prioritize tracking their expenses meticulously. Every dollar is accounted for, every purchase categorized. By doing so, they gain clarity on their spending habits and identify areas for optimization. Fortunately, technology makes tracking easier than ever. Use apps like Rocket Money, You Need a Budget, Monarch Money, or even a simple spreadsheet. Log every single expense, every coffee, every grocery bill, every subscription. After 60 days, analyze your spending patterns. Are you overspending in certain categories? Are you making impulsive purchases? Can you negotiate better rates on bills or find cheaper alternatives? This exercise, though seemingly tedious, is invaluable. It reveals hidden leaks in your financial ship and empowers you to plug them. Most people find they can save an extra 10 to 15% simply by becoming aware of their spending habits. It's like going on a diet. Awareness is the first step to making healthier choices. Step 2. Conquering high-interest debt, the wealth killer. Once you have a handle on your cash flow, the next crucial step is tackling high-interest debt. The average American carries a significant debt burden, over $22,000 across credit cards, personal loans, and car loans. This debt, coupled with today's rising interest rates, can quickly erode any financial progress you make. Here's the simple rule. If the interest rate on your debt exceeds the return you can safely generate from investments, prioritize paying it off aggressively. Every dollar you send towards high-interest debt is a guaranteed return, equivalent to that interest rate saved. There are 2 effective methods for debt repayment. The first is the avalanche method. This mathematically superior approach involves prioritizing the debt with the highest interest rate, then moving down the list. You'll save the most money on interest payments in the long run. The second method, the snowball method, focuses on the psychological aspect of debt repayment. It involves tackling the smallest balance first, regardless of the interest rate. This strategy provides a sense of accomplishment as you eliminate debts entirely, motivating you to stay the course. Both methods work. Choose the one that resonates most with you and commit to it. The key is to be proactive and strategic about paying down debt, freeing up more of your income for building wealth. Step 3. Harnessing the power of a Roth IRA, your tax-advantaged wealth builder. With a solid understanding of your cash flow and a plan to manage debt, we can move on to the exciting part, investing. Specifically, we'll focus on a powerful tool for long-term wealth building, the Roth IRA. A Roth IRA is a retirement account that offers incredible tax advantages. You contribute after-tax dollars up to $7,000 per year as of 2023. Here's the beauty. All the growth within the account is tax-free. And when you withdraw the money in retirement after age 59 and a half, it's completely tax-free. Imagine the possibilities, decades of tax-free growth, allowing your money to compound exponentially. It's a phenomenal tool, especially for younger investors in lower tax brackets. You'll have more after-tax income to invest now, and your money has ample time to grow. Opening a Roth IRA is simple. Most brokerages offer them, and the setup process is straightforward. Don't let this opportunity pass you by. Start investing in your Roth IRA as early as possible and maximize your contributions each year. Step 4. Choosing your investments, the blueprint for long-term success. Now that you have your Roth IRA set up, the next step is deciding where to invest your money. This is where many people get tripped up, lured by get-rich-quick schemes, or paralyzed by the fear of making the wrong choice. Here's the truth. Building lasting wealth requires patience, discipline, and a long-term perspective. Here are 4 key principles to guide your investment journey. Diversify. Never put all your eggs in one basket. Spread your investments across different companies, industries, and asset classes. This diversification mitigates risk. If one investment performs poorly, others can cushion the blow. Don't try to beat the market. It's tempting to chase the latest hot stock or try to time the market, but the reality is that even professional investors struggle to do this consistently. Instead, focus on riding the market as a whole, capturing its long-term growth potential. Embrace index funds. Warren Buffett, arguably the most successful investor of all time, recommends index funds as the best investment for most people. Index funds offer broad market exposure, low fees, and built-in diversification. They're a simple and effective way to participate in the stock market's growth. Dollar cost average and stay the course. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market fluctuations. This strategy takes the emotion out of investing and helps you buy more shares when prices are low. Most importantly, stay the course. Resist the urge to panic sell during market downturns. The stock market has always recovered from recessions and crises, rewarding those who remain patient and disciplined. Understanding market returns and setting realistic expectations. Over the past century, the S&P 500 has delivered an impressive average annual return of around 10%, including dividends. However, it's crucial to understand that past performance is not indicative of future results. Market returns are influenced by various factors, including interest rates, inflation, economic growth, and geopolitical events. While the past decade has been exceptionally strong for the stock market, it's unlikely that these returns will continue indefinitely. Experts at Vanguard and Charles Schwab predict more moderate returns in the coming decade, ranging from 4% to 6%. It's important to set realistic expectations and understand that market cycles are a natural part of investing. My personal investment strategy: transparency and diversification. To provide further context, I'll share my personal investment approach. My goal is stability and diversification, prioritizing capital preservation while aiming for long-term growth. Real estate. A significant portion of my portfolio, 35%, is allocated to residential real estate. I've acquired properties over the years, mostly fixer-uppers that I've renovated and rented out. Real estate provides rental income, potential appreciation, and a hedge against inflation. Index funds. Another 35% of my portfolio is invested in index funds, primarily tracking the S&P 500 and international stocks. I follow a simple buy-and-hold strategy, regularly contributing to these funds regardless of market fluctuations. Cash and equivalents. I maintain a 20% allocation to cash, high-yield savings accounts, and money market funds. This provides liquidity for unexpected expenses, business needs, and real estate opportunities. While I could potentially earn higher returns in the stock market, I value the peace of mind that comes with having readily available cash. Alternative investments. The remaining 10% of my portfolio is dedicated to alternative investments, including a small allocation to Bitcoin. This is my fun money bucket, where I explore investments with higher risk and potentially higher reward potential. This diversified approach allows me to weather market volatility and pursue long-term growth across different asset classes. It's a strategy that prioritizes stability and aligns with my risk tolerance. The path to wealth, a long-term journey, not a sprint, Building wealth is a marathon, not a sprint. It requires patience, discipline, and a commitment to making smart financial decisions consistently. Here are the key takeaways. Master your cash flow. Track your expenses, identify areas to save, and free up more money to invest. Tackle high-interest debt. Prioritize paying down debt with interest rates that exceed what you can earn from investments. Maximize tax-advantaged accounts. Utilize accounts like the Roth IRA to shelter your investment growth from taxes. Diversify your investments. Spread your risk across different asset classes, industries, and investment vehicles. Invest for the long term. Embrace a long-term mindset, avoid trying to time the market, and stay the course through market fluctuations. Remember, building wealth is a journey, not a destination. There will be ups and downs along the way. But by following these principles, you're setting yourself up for financial success and the freedom that comes with it.